Keith McCullough, and welcome to day 2 of the summit. You don't have Darius hosting today, so if you have any feedback or pushback on that, there's nothing I can do. I have to do them today. So we're going to bring Darius back throughout the summit, but I'm definitely pleased here to have this discussion first with Jeff Snider, who is the head of global research at Alhambra. And I was trying to pronounce it different ways, but I'm kind of good with Alhambra, right?
Yeah, Alhambra, whatever you want to do.
Whatever you want to do.
That's right.
Well, what we really wanted to do and what I wanted to do for all of you is get into a topic that I think is a little bit rabbit hole, but it really matters, and a lot of people in macro are talking about this these days, which are basically dollar liquidity, talk about the repo market and the issues associated with what's going on there. So again, it's not a simple topic, and that's why we didn't bring in a simple guy. We're going to bring in somebody who actually knows what they're talking about, and you're one of the few people that actually had been writing about this prior to the actual repo market problem. So thanks for doing that.
Yeah, my pleasure.
And I want to get into why did you start doing your research that way, and most importantly, what is your process in terms of how you do your research?
Well, where I started was way back 20 years ago, back in college. I started doing a lot of research into banking, the banking sector, monetary structures. And what I found out was that a lot of the things that you're taught in school, a lot of the things that you're taught in this business about what we should believe as far as central banking and money, it didn't seem to be that way. And so for me, it's always been, tugging at these little threads of things that may not seem like they're exactly the way it's supposed to be in the textbook. Mm-hmm. The economic textbook lays out central bank is in the middle of everything, and the monetary policy derives everything from that. Don't ever fight the Fed. Don't do it. It's never a good idea. And to me, that was always like, why not? Why shouldn't you fight the Fed? They're not perfect. They're not all powerful. Even if they do have a printing press, there's definitely space for something to happen. And what you find out is between where the economic textbook leaves off and where reality begins is an enormous space. Yeah. So my process starts in that space and to look at, how did things actually work out there in the monetary system? Mm-hmm. What you find out is that the monetary system, even saying monetary system, it's very hard to define what that means. And also, it's expansive. It's enormously encompassing about a lot of concepts, a lot of way things actually work that throughout the textbook, because it's just not even in there.
Mm-hmm. No, and most people, I think that frustrates them in the beginning, because even if they did study economics, it may not have been worth their while. For me, at least, I like to think of my BA in economics at least starts me with what not to do and their framework.
Right.
What not to do in terms of markets, of course, but their framework's important to understand, like the academic framework, so that you can start to, it's not fight the Fed. We always call it front running the Fed. I mean, if you can stay ahead of the Fed by 3 to 6 months, most of the time, you can make a ton of money in a lot of different things. Rates, dollars, obviously, currencies, markets, factor exposures, et cetera. So,
right.
So I can empathize with that starting point, because for 20 years, I've been waddling around in the same kind of space that's wide open, it seems.
Right, and there's a lot of truth to what goes on. There's truth behind what we call there's shortcuts or myths that we all try to live by, and there's a lot of truth to them.
Yep.
And monetary policy, in fact, is really about, hey, if you believe what the central bank is telling you, if you believe what Janet Yellen or Ben Bernanke or Jay Powell are saying, then that's what's supposed to happen. It's almost a self-fulfilling prophecy. Mm-hmm. So you have to understand the way that they believe things are supposed to work, because in a lot of ways, that's actually what happens. Mm-hmm. There's a lot of things that, whether it's front-running the Fed or just basing your entire viewpoint on what does the central bankers, what do the authorities say, not just in the U.S. but elsewhere.
Yeah.
And so you have to understand what they're thinking, because it's important to understand how that plays out in expectations, at the very least, sentiment, things like that, if not necessarily into the nitty-gritty details of how things actually get done.
Yeah. Now, on that, that's like for those of you that don't know what a plumber is, Jeff's a plumber. So we talk, the buy side would consider you somebody who's an expert in the plumbing of the entire central banking system, particularly when it comes to the U.S. side. Do you think that you're more of a critic of their actions, or somebody who's just, again, plumbing what they're doing and trying to get ahead of what they're doing might impact the next thing in markets?
I think it's more deconstructing, not just what they're doing, but what should they be doing?
Right.
What is it they're not looking at? What are they not seeing? And the repo market last month is a perfect example. Yeah. Something that should not have been a surprise, but it was. It caught everybody off guard. And so it's trying to understand and deconstructing the system so that we understand, okay, why did they miss this? Mm-hmm. What didn't they see?
Yep.
So we know ahead of time okay, what are they not doing? And also, what are the implications of what are they not doing? What does that mean for the next couple years, next 10 years, long term, that kind of thing. So we have to break down what we're supposed to know and to put it into terms of what should really be happening.
Yeah, that's an important thing to get right
Yeah.
a lot of the time. And I want to get back to the repo market, but first I want to give you a chance to define, like, what is the world's reserve currency in terms of how you define it, and why is it so important?
Well, everybody, we're all taught that, August of 1971, President Nixon closed the gold window, thus ended Bretton Woods. Gold was, banished to the dustbin of history, and what sprung out of that was a dollar reserve standard, which isn't actually true. It's dollar denominated, but we actually have something called a Eurodollar standard, which is a global currency. And what I mean by global doesn't mean that necessarily that the dollar extends globally, but that there's a global system, and it's a financial credit-based system whereby banks create all sorts of dollar-denominated liabilities, all sorts of weird and creative forms of liabilities, and these are what pass for a global reserve system. And a global reserve currency is an important function that I don't think a lot of people really appreciate. I mean, most often when you talk about a global reserve currency, people think, well, okay, we get to denominate oil in dollars. That's what it means to be a reserve currency. But there's so much more to that, and it's really vital stuff that impacts every corner around the world.
I mean, at this stage, and we'll do both. We want to do repo market, and we want to do Chinese yuan. We can do within that framework. That's what I wanted to set up first. Is just let's start from there, because then we have somewhere that people can base from, and then start to think in a different way potentially. I think a lot of people actually probably think or intuitively will agree with what you're saying. It's maybe just not the way that they started thinking about it. Eurodollars. So people talk about that a lot. I mean, Raoul Powell and I will talk a lot about how to position against the Eurodollar if you think that the Fed is indeed behind the curve. Right. Can you talk a little bit about that and why that's such an important thing for Fed fund futures expectations, future rate hikes or cuts, or any expectation embedded therein?
Well, the Eurodollar futures market is a subset of the global reserve currency. It's a way to basically, for these financial firms to manage their liabilities. And that particular part of the market says, okay, what is the Fed going to be doing in the future at specific points in the future?
Yep.
And the Eurodollar futures market, in fact, was one of the first markets that spotted these rate cuts coming. We're talking all the way back in June of 2018, back when it was, hey, there's rate hikes and inflation as far as the future, as far as you can see in the future. And here's this one market that I don't think many people know about the Eurodollar futures market. I don't think many people have ever heard the term Eurodollar.
Yeah.
So, but there's this giant market out there. I mean, some of these contracts go into the trillions. It's a very deep, sophisticated market. And here it was in the middle of 2018, when everybody said rate hikes, inflation, everything's great. The Eurodollar futures curve inverted, which said there's a chance that we're going to get rate cuts next year and the year after. By the way, they're probably not going to be just one or two. They're going to keep coming. What all that said back in 2018 was, hey, there's something not right here. There's something wrong in the global monetary system where these very sophisticated, very large players in the market were starting to hedge that, okay, if this doesn't get fixed in the middle of 2018 going forward, if nothing changes, there's going to be rate cuts because the consequences will be pretty drastically negative, and that's exactly what we've seen. That's what's happened.
Yeah.
So when we talk about the repo market, and we'll get to that, but the larger, wider system was saying, well over a year ago, even before then, there was something not right here. There's something that's a little bit off, and we're starting to get a little bit worried about it.
Yeah, this is it's quintessentially how we do it. I mean, your process is your process, mine is mine. We always A/B test where the economic trajectory is going in quads, and I think you're familiar with that.
Yeah.
So it's interesting that in the summer of 2018, you already had global quad 3 and 4 developing, obviously in China, in Europe, in emerging markets, and all you really needed to do was have a projection that the U.S. was to tip into quad 4. Then, of course, your outlook would be to buy treasuries, and then you'd be expecting rate cuts. So it was a very interesting thing. I think most of our, we have two big audiences. We have institutional clients, and then we have what we friendly refer to as our mass market audience. It's just a difference in terms of what they pay. But our mass market audience absolutely understood that, and they started buying 2-year treasuries. But they're like, how do you do that Eurodollar thing? And that was really like, there
was a lot of money to be made in the Eurodollar
Oh
futures.
my God. I mean, it was just like, but it really, if you A/B test A/B test again. You have a model that has some, God forbid, your head of the Fed on, a non-globally synchronized recovery, which was what was happening at this time last year, and then you get the U.S. Quad 4 and Q4 bit, which has basically made it a fait accompli. You're basically sitting there saying, I cannot believe that the world is this short of treasuries across the curve. It was the biggest net short position in the history of treasuries. And when you looked at that, what did you see? Some people told me that Keith, well, there are all these different plumbing reasons for why that position really is, the street really isn't that short of treasuries come October. Really, actually it was in August, September, October, that position got to an all-time high.
Yeah, I'm not sure who exactly was short treasury, but you're right, everybody was. Because that was the common narrative, right? Again, don't fight the Fed. Jay Powell says we're going to, aggressive inflation, aggressive rate hikes, those are going to be very bad for the bond market. And I think what ended up happening for a lot of people, certainly in the financial media, was that they had a preconceived conclusion or predetermined conclusion that interest rates had nowhere to go but up, and then we'll find some data that makes it sound like that's the right case. When in fact, if you looked at the curves to begin with, even going back into 2017, the fact that the yield curve had flattened out where it had flattened out was a bright flashing warning that, hey, this inflation, this economic breakout, it wasn't happening. The bond market was saying, no, this is not happening. Well, so I don't know who was short treasuries. I mean, somebody obviously was.
Well, the whole free, the whole free or non-free institutional investing world was short treasuries. I mean, Jeff Gundlach was underweight treasuries. I mean, there's like bond kings and queens. It was like a massive position.
You couldn't be a bond king unless you were short treasuries.
Well, he said, and to be fair to everybody who loves them, and again, I don't love anybody other than my wife, and my kids. But the reality is that he was saying, like a lot of people, that we were going to see a spike in the 10-year yield to a 4 handle and then maybe higher. And they thought...
Jamie Dimon came out last summer, right around the time the Eurodollar futures curve flipped. He said, get ready for 4% 10-year treasuries, maybe 5%.
Yeah.
I mean, this is the head of one of the global banks that was, by the way, buying the treasuries while he was saying they were going to sell off.
That's why you want Jamie Dimon to run the company, not to run your book, long, short book. No.
The bank manager.
But I mean, these things are, and a lot of people, another thing you said, and we're going to get to the repo market next, but the curve. Okay. What is there possibly to worry about here? Even though as the curve was heading towards inversion, which is, again, the rate of change move matters a lot more than the actual inversion itself, you had nobody really paying attention to that. I mean, a lot of buy-siders were, clearly. I mean, plenty of people made money on this, by the way. It's just that the majority of people that shorted treasuries on that lost a lot of money. So, do you agree with that? Is the rate of change and the shape of the yield curve something that you should watch daily?
Oh, the yield curve tells you everything you want to know about anything. The yield curve has so much more. Well, again, we're talking about a global reserve currency, a global monetary system, in which the Treasury market is a big part of that. Part of the repo market, and so. It's not just about, the yield curve inverted, therefore recession. That's what the public knows. As far as the public goes, that's the only time you pay attention to the yield curve. And you're exactly right. You pay attention to the yield curve because of its shape, how it's changing, where it is nominally in the spectrum. And the fact that it was flattening out at around 3% in 2017, that was a huge signal. Hey, something is not right here. Jay Powell says, actually at that time it was Janet Yellen. Janet Yellen said everything's great, we're going to go into an inflationary breakout. The bond market was saying, no. Something's going to happen before you get there.
Yeah, well, the bond market nailed it. It nailed the European, Chinese, and emerging market slowdown that started at the end of 2017. Yep. That's exactly why that curve stopped changing, or stopped looking the way it had looked when the global growth recovery was synchronized.
It should not have done that. It should, if they were right, that you should have seen it steepen out. You should have seen back rates like Jamie Dimon was talking about. They would rise. They would back up. 3, 4, 5% would be in a relatively good space for normalization. Yeah. But the bond market was saying, we're not normalizing here. There's something wrong in the monetary system that's going to prevent these things from happening. Something would go wrong before you ever got there.
And people are like, well, what was it? What is it that's going to go? Because we do have a lot of people that are looking for the end of the world. I mean, or have always thought that it was going to come. But by the way, it has happened once every 7 years for the last, going back to the last 2 cycles, peaking and rolling over. So we understand that it's something that you should be concerned about. But on the repo market, can you explain, to people that have no idea? A lot of people didn't, obviously, but can you just use the same, time series and sequence of events that you've made the statement that made you say should have been a surprise to anybody?
Well, going back to early 2018, we started to see the federal funds rate, with the effective rate, rise within the Fed's policy range. Yep. That was indicative of some kind of tightness. It wasn't really, it wasn't anything to be concerned about. It caught the Fed's attention in the middle of 2018. They adjusted IOER, which was the interest rate that they pay on excess reserves, which are the bank reserves the Fed created after doing quantitative easing.
Yep.
So there's all these, trillions in bank reserves. They started, the Fed, under quantitative tightening, so-called, they started to reduce the level of bank reserve because they expected, and this was the plan all along, that after the crisis had long been in the past, after the financial system had finally healed after however many years since the financial crisis, they were going to step back and let the private liquidity system take over from there. The way it was before the crisis had happened.
Yep.
The way they were looking at it was, hey, we had to get into it because we had this global panic. We expanded our balance sheet by trillions. Now we're going to go back to normal because we think everything's great. The economy's fine. The financial system, as Janet Yellen kept pointing out, was resilient. They actually believed that. And so they started drawing down the level of bank reserves, anticipating that the private system would step in and fill in the gaps as it had done beforehand. But as early in 2018, there were already signs that something wasn't right here. That wasn't happening. Where dealers should have been providing liquidity in the repo market and the federal funds market and some other more esoteric markets around the world, that wasn't happening. And so it just kept building and building where the federal funds rate rose within the range. Dealers were continuing to be absent. The Fed didn't really know what to do about it. They lowered IOER 3 times before the mid-September, all trying to get these dealers, these private dealers, to step in and provide the liquidity as the Fed took a step backward. And all that happened in September was we got to a seasonal low point in the calendar.
You're talking
that
about
exposed
this year, yeah.
This year, yeah. This goes back to early 2018.
Yeah.
Again, why was the curve flattening out in 2017 and 2018? That's because the dealers knew there was no liquidity there, and it was going to continue that way. So by the time we get to 2019, you see all these weird things happening long before we get to mid-September. Federal funds goes above IOER. That's not necessarily an end of the world type thing, but it was a key indication that, okay, where are the dealers here? Where is this private liquidity? It's not happening. And then we get to September, which was a really seasonal low point in the calendar that exposed, some flaws, some maybe misinterpretations in the system. And all of a sudden it turns into this big thing that should never have been a big thing. And again, we're left asking the question that we've been asking for a couple years now. Where are the dealers? Where are the liquidity providers? They're supposed to be the ones that are filling the gap. And even the Fed has asked that question. We expected that the dealers were supposed to be in here providing liquidity, and they weren't doing it. And so that's the real lesson of that repo thing. It wasn't that it was a credit event or it was the end of the world, was that it exposed the flaw in what this monetary theory. Where are the dealers? Where are the liquidity providers? They're absent. They're not there.
Well, it's similar to pretty much anything Jamie Dimon could get involved in. Do they really want to be the liquidity provider in anything of old? I mean,
not nowadays, no. I mean, look, this isn't 2006 anymore.
Right.
We can't go back to the way things used to be.
Yeah.
And unfortunately, the world needs us to go back to the way things used to be. Either we need to create a new monetary system, or we need to go back to the old monetary system. Yeah. And we aren't going back to the old monetary system.
It's actually, and perversely, it's a good call by, not perversely, it's not even surprising. I mean, for Dimon to just have had a great quarter, guys, pro-cyclical quarter, late cycle, I'm sure that's what the street told him. But if they were on the wrong side of that repo move, they would have not had a great quarter.
Right.
I mean, if the dealer, it's like Goldman. They were on the wrong side of the Uber trade. I mean, that's a lot different than being on the wrong side of the repo market and being big. It was a surreal move for anybody looking at most people that started macro touristing the site and saying, wow, look at that. Look at that. Now that must mean something.
Right. Because
it was such a surreal point-to-point move in time series terms.
Yeah, and obviously it stood out. I mean, you have record repo rates, that's going to get people's attention. Yeah. But what concerns me is I don't think it's getting people's attention for the right reason.
Right.
And the Fed has done, what is the Fed good at? The Fed is very good at public relations, getting the public to focus on the thing that doesn't really matter. And so that's what they've been doing since then. Oh, we'll do overnight repo operations. We'll increase the level of bank reserves when the level of bank reserves was supposed to be irrelevant and immaterial. And so now everybody's talking about this quantitative easing that isn't quantitative easing, which all it is again, raising the level of bank reserves because that must be the problem. When again, what we just talked about was the real problem is where are the private dealers? They're not constrained by what they don't have in bank reserves, they're constrained by their risk-taking behavior.
Yeah, they're willing
lack
to
of
take on risk.
Right.
Yeah,
that's where the liquidity is.
Yeah.
The liquidity is they don't want to provide it.
Well, if you thought they weren't there before because they weren't there before, they're definitely not going to come back now.
Right, and that's the big lesson here. Right? Okay, this was a dress rehearsal for if we do have something like a credit event. And what the dealers took away from that was, holy crap, do I really want to provide liquidity in a liquidity event? Hell no, I'm going to stay away. I think that's why the Fed has pushed itself into doing something.
Yeah.
They got to do something here because people are talking about something that nobody ever talks about.
Yeah, and it's the most boring. For those of you guys and gals, you don't know what the repo market, GC repo market, general collateral. this is like the most basic of banking relationships and operations.
It's esoteric, boring, it's complex, it's crazy. Yeah. It's not it's not the stuff you hear about in the economics textbook.
But what it does, and I want to, and by the way, keep your questions coming in. They're coming in hot here because Jeff has plenty of answers. And if you want to go down the rabbit hole, you should on these topics with him. What it does is it just keeps bringing up this word, illiquidity. Illiquidity. So there's illiquidity in the repo market, there's illiquidity in dollars, there's illiquidity, if you want to think about it in terms of Eurodollars, how do you want people to think about this global shortage of dollars?
Just as we were saying before, the Eurodollar system isn't a system of physical Federal Reserve notes flying around the world. It's a bank-driven system where it's almost a virtual currency system. One bank gets together with another bank and they trade liabilities, and that performs a financial operation. Mm-hmm. Therefore, it's money. And so, a way to think about this monetary system is that it's a credit-based system, and credit-based means banks. So if the banks, if we're sitting here asking, where are all the banks? That's going to be illiquidity. That's going to be a lack of money. It's going to be a global dollar shortage because we depend upon these banks to provide quote-unquote dollars or Eurodollars, whatever you want to call them. They're really nothing more than financial liabilities. And if they're not willing to provide what liabilities, the net result is shortage, monetary shortage, illiquidity, whatever kind of word you want to come up with. It's basically the same thing. It's a lack of, the old economist term, currency elasticity.
Well, geez, once we start getting rid of some of those things. No, that's important, obviously. So now let's tie that to where I started with in terms of what would have made somebody start to buy treasuries in the summer, late fall of 2018. It's that the world started to slow and then the U.S. joined it. Okay, so if you take that and you take what the Chinese have been doing, which is borrowing and dollar-denominated debt, how does what's going on in the Chinese yuan affect your view of this dollar shortage or Eurodollar setup?
Well, to me, it's actually cause and effect. The cause of the Chinese shortage is a dollar shortage.
Yep.
So the Chinese have a massive dollar problem. And I know, we're told it's the other way around. That, if the Chinese wanted to, they could destroy the U.S. They'll sell all their treasuries overnight, and we're all screwed. But that's actually the opposite. It's actually the other way around. The Chinese need the dollars because those dollars, or a good many of them, end up on the People's Bank of China's balance sheet, the central bank's balance sheet.
Right.
And they actually form the basis of China's monetary pyramid. So in a lot of ways, the Chinese economy is dollarized. Mm-hmm. They need our dollars more than we need them to buy our treasuries. And what that does is, if we have a global dollar shortage or a global liquidity problem, that forces the Chinese to constrict their own monetary system, so that there's a lack of monetary growth inside of China, due in large part to the externality of this Eurodollar system. Mm-hmm. And that's you have a Chinese system, a Chinese economic system, Chinese financial system that's already pretty risky, that's already pretty well stretched, and you add to this dollar problem, and that becomes an internal monetary problem. It makes a really bad situation potentially more explosive, potentially more amplified than maybe it otherwise would have been.
Mm-hmm. If you guys go to slide 34, I'll get Jeff's reaction to this. But we try to walk people through this increasing dollar shortage here. I'll just pop this chart up here in a second. On the left side, we have the developing current account deficit, and on the right side, we have obviously the leverage that's in the Chinese system. That's on slide 34, guys. This is, I think that this is the most basic setup in terms of the reality that exists. So again, if you look at your China from before, when the economic growth period was peaking, obviously back in here, all in here, you got this very different situation than what you have down here. That line obviously could be red, right? Because that's the rate of change. That's what's happened. And then all the while, this has happened in terms of Chinese leverage in the system. And this is, the Kyle Basses of the world will immediately call that out, as it should be called out.
Right. Well,
you have this very dynamic situation that is not like your former emerging market crisis because they have a close capital account, obviously, but they do have the developing central tendencies of an emerging market crisis, which are growth is slowing, and you're making up your numbers, and at the same time you're using leverage, and in this case U.S. dollar denominated leverage, to try to offset what it is your cyclical slowdown.
Right, and it becomes self-reinforcing too, right? At some point it's okay, it's not working, therefore you are even more risky, therefore I want to give you even fewer dollars, and it just becomes a downward spiral, at a point where, maybe it's not sustainable any longer.
Yeah.
And it's internal as well as external. And I think that's really my key point, is that it's not just an external dollar problem, it becomes an internal dollar problem.
Right.
The Chinese are actually executing a form of quantitative tightening, not a voluntary one, but the PBOC's balance sheet is being restricted by the lack of global flows.
Yeah, if you go to slide 35, guys, what Jeff just said, this is a chart which you'll know, obviously, of Chinese interbank liquidity conditions. This is a disaster.
Yeah.
Relatively speaking. I mean, would you have ever thought that this, after, you get, this obviously happened, so you get 6 cuts, but there's absolutely nothing that flowed over to this.
And so we're back to asking the same question, where are the banks?
Yeah.
The banks in China too, they're choosing not to provide liquidity. Even though the government is saying with the triple R cuts, hey, go ahead, provide more liquidity to the system. We're letting you use more of these reserves. And the Chinese banks are saying, we'd rather not.
Because we're already levered.
Right. Why would we do that? That would be a pretty stupid thing to do.
Well, how do you? Is there naturally people are going to ask the question like, how does this end? I mean, how would you just rationalize where we go to next?
Well, there's really no real good way to predict how this ends. There's any number of ways this could end. Right. Some of them could be good. I mean, you could look at in terms going back to the Eurodollar system, a Bretton Woods too. Getting together. We require a lot, and this is not a high probability event, but it's possible. It's possible that authorities get their heads out of their butts at once and say, hey, we need to do something here. We need to cooperate. We need to create a monetary system that's actually stable, that works for everybody, and that's something that could happen.
So that's like
not realistic.
That's way bigger than the bean deal that they got going on right now. The soybean. That would require absolute cooperation, global cooperation, and an actual bowing down to the Chinese need for this.
And it would also require a different textbook. We need to throw out the old economics textbooks and rewrite a new one.
Okay,
so that's even farther away.
So
than
the solution, like I think, at least I would say, we're not at this stage of Chinese-U.S. relations where that is you're likely to have the Bretton Woods, part 2020 or whatever you want to call it. What else? Like, what's the worst that can happen?
Well, the worst can happen is that it doesn't blow up. And I know that it sounds like a crash tomorrow would be the worst case. To me, the worst case is this continues. We just go on and on and
just
on.
Bleed it out.
Right. A death by 1,000 cuts that extends over. A Japanification. Low growth, no inflation, nobody having any answers. That to me is the worst case, because time is everything.
So you'd rather, and that might sound like just not nice to some people, but you got to let markets clear. I mean, if we were to let it clear today, it would be a certified disaster.
Well, if they had let 2008 be 2008,
right?
Whatever it was going to be, if they had let that go, that was the warning sign that hey, this is no longer a workable system. Mm-hmm. Workable system globally. I mean, it was a global financial crisis. And again, how could it be a global financial crisis? Because we're talking about a global monetary system. Mm-hmm. So if they had taken 2008, it wasn't about subprime mortgages. It was about global dollar problems. If they had taken that the right way and thought about it the right way, that would have been the opportunity to get everybody together and say, we need to rebuild this thing from the ground up. Mm-hmm. But now, here we are 11 years later. We've lost 11 years, spinning our wheels and making everything worse. Mm-hmm. So as you pointed out, it's even more difficult to get kind of cooperation that's necessary to move forward, because now everybody's at odds and everybody's fighting for their own little piece of a shrinking pie.
Well, do you think that, there are plenty of, like you said, there are multiple ways that this could go. Do you think that the Chinese could just say, okay, USA, go over there, we're going to go do our own system with the Russians, the Iranians. You can come up with a constellation, by the way, of a number of countries that have bought a shitload of gold that are doing something for different reasons than the monetary system that they've had to deal with and really be hostage to for since Bretton Woods.
Well, again, it gets back to what is a global reserve currency and what does it actually do? It's not something you can just conjure overnight. You can't just say, I'm China, I want to start paying for oil in yuan. it's not going to work. You need dollars. You need
Yep.
you need support. You
That's
need
not gonna
infrastructure. You need liquidity. You need all of these things to happen for a reserve currency to actually function properly. And it's a burden. It's not a privilege. People talk about the U.S. dollar has a privileged status as the reserve currency. It's actually a huge burden.
Yeah.
And so, do the Chinese want to take on a reserve currency burden? No, I don't think they. I think they would rather somebody else do it. I think their largest complaint is let's build one that actually works.
Yeah, exactly.
Because this isn't working. So there's a lot of work that would need to be done to create. Historically, there's always been currency blocks. It hasn't been a single reserve currency.
Hey.
There's usually been
Point.
one block here, one block there, one block over here. But even to get to that narrow kind of a existence would require a hell of a lot more than I think any of these countries are ready to take on.
Mm-hmm. And a lot of these countries have negative interest rates too, which is a wholly new dynamic.
Right.
Which is within the construct of
Problems
blocks.
on top of problems on top of problems.
Yeah.
And which one do you start with?
Yeah. Oh, that's another problem in the repo market. I mean, why would
Right.
why would a corporate, if you run a company, I run a company, why would I go do my general collateral repo with a bank that gives me a negative interest rate on my cash? Why would I do that? I mean, unless you're an idiot, you wouldn't do that. So you're seeing more and more people go towards the U.S. reference rate and the U.S. windows, where there is less liquidity. I want to get some questions now because we have
Sure.
about 15 minutes to do that. And thank you. The questions are quite good. They're rolling in as I expected that they would. Here's a really good question, Jeff. Why wouldn't the Fed force their minions, i.e., the dealers like JP Morgan, to provide liquidity to be a participant in the system, sort of like being a specialist on the New York Stock Exchange?
I don't think they're able to do that. I don't think they, this isn't communist China where they can come in and say, hey, tomorrow you're going to provide X at X. What the Fed, their operative theory under the repo operation in this new not QE is we're going to give you bank reserves and we expect and we hope that you do something with them. Now, whether you do or not, I mean, we can't tell you how to run your business.
Can't make you do it.
Right, but that makes sense, and you would think that would be what they want to do. But again, you take a step back and look at this from an overview. The Fed isn't in those markets, and it depends upon the dealers to put it in the market. So if they're giving the dealers bank reserves, they're expecting the dealers to do something with those bank reserves, and if the dealers don't want to, that's the end of the conversation.
I guess, and there's a couple of other questions along these same lines. I mean, can they put overt or just
Sure.
public pressure on the banks? I mean,
They could.
Because
but at the end of the day, it's still.
They haven't.
Do you know what goes on the repo desk at any one of these banks? Nobody knows what goes on the desk. In
I
fact,
don't
I don't think a lot of the bank managers knows what goes on. So I mean, they could call all of the CEOs into the headquarters on Liberty Street in New York and say, hey, we want you guys to provide liquidity tomorrow, but that doesn't mean they're going to.
No, exactly. Well, actually, a lot of these questions, people are implying that they think it's the job of the bank. Like literally, this one question says, so would it made a difference if the banks just did their job, and isn't it their job?
Well, their job is to provide that service, but they're going to do it at a service they believe that won't turn them into Bear Stearns.
Right.
That's what we're really talking about here is they'll provide liquidity if they think there's the opportunity and as well as the lack of risk. If there's an opportunity and it's a low risk, they'll provide all the liquidity the system needs. What they're telling us and what we should be taking away from this, the fact that they're not participating in it, is they're seeing something out there that is preventing them from providing what is a very basic and essential service. Mm-hmm. And that's a much bigger question than just, hey, throw some dollars in the repo market.
Yeah, exactly. People are complimenting you too. Been following you, Snider, for a year now. Good stuff, So people do pay attention, and they do appreciate. You put a lot of good stuff on Twitter in particular, so people do appreciate your work, and that's cool. But the other questions have to do with the steepening. Let's go back to the shape of the curve. We got a bunch of questions. Thank you for those questions. We have seen a steepening in the most recent weeks. We're back to on 10s, 2s, 14, 15 basis points wide. From here, is that telling us something new?
The curve in the last couple of weeks, no, that's, the long end of the curve, the long end rates have backed up a little bit from where they were, which was almost near records.
Yep.
The 30-year was a record low. So that's not the steepening that you get just before a recession.
Yeah.
The steepening you get just before the recession is the short-term rates drop.
Yeah.
And so we've kind of got, it's more of a fluid dynamic. The curve's just kind of meandering around, waiting for what's next.
Yep.
What's next could be something positive. I don't particularly believe that, but it's possible.
Well, people, I personally, one of my biggest positions is still the short end of the curve because I'm waiting for the Fed to catch up to my nowcast of where the economy is. So that's where you would expect a steepening. It's probably not what you were taught at CNBC or someplace like that, because they have you living in, with the fear of God of a inverted yield curve. But to Jeff's point, it steepens when that is actually there because even the Fed figures it out. So they'll drop.
And they're always the last.
Exactly.
Right, and that's why you see just before a recession hit, the yield curve steepens out, but it steepens out front end first.
Front end first.
Right,
Bingo.
the front end rates drop, and then that's the signal that, okay, things just got serious. Mm-hmm. We aren't quite there yet, but the bond market, the curve right now is more of, okay, we everything we thought was going to happen has happened, but we're not really in sight of the big thing, whatever that big thing is, and everybody's got a theory about what the big thing is that's spooking the market. I have my own theory. I think it's the collateral system. So the bond market isn't yet there to, okay, this is going to happen. It's still a probability. It's still a good probability, but we aren't quite to the end stage, end cycle, however you want to call it yet.
If your theory is it's the collateral system, if that is in fact what it is, and I overlay that with a credit spread widening in conjunction with negative year-over-year earnings, let's just say all that happens at the same time, which is what I currently think is happening. Shouldn't it equate to yield spreads, high yield spreads, widening at a faster rate if it is a problem with collateral and how it's priced?
Yeah, because there's a lot of that junk collateral in the system.
There's never been more.
We don't know how. We don't know how much is in the system. And I think that's why dealers are sitting on their hands, because they do know. They have an idea of how much crap collateral is in there. They have an idea of what that would be if it turned negative, if we started to see spreads blow out. What would that do to the repo market? There's a lot of negative potential. And I think they have an idea of what that negative potential is, and that's why J.P. Morgan took advantage of it in the latest quarter, because they finally saw it too. Because there's a lot of the stuff that's been built up over the last couple of years. It's reminiscent of, but not exactly the same as the subprime mortgage crisis beforehand. It's not the same degree. It's not to the same level of stupidity, but it is some level of stupidity.
Yeah.
And I think they're aware of it, and that's why the curve has behaved the way it has. That's why the illiquidity has happened. That's why we keep asking, why aren't the dealers providing liquidity? Well, they know something about the potential for problems that are probably buried deep down inside the system. Going back to what you said before.
It's interesting what you just said about J.P. Morgan in the quarter. Like today, they clearly made a couple good moves in this market. I mean, Goldman didn't. They did. I didn't look at Citi's numbers, but isn't that just the point? That they could.
They finally stopped listening to Jay Powell.
Yeah.
I think that's what it was. All of these banks, you see it throughout these cycles. They buy, or their FICC revenue in particular seems to go along with whatever the central bank forecast is. If their economist is on TV saying we're going to get inflation and rate hikes, then they can't seem to make money. When they stop listening to those forecasts, all of a sudden they can make money.
Yeah, it's true. So Jeff, what do you think that the Eurodollar futures are? What are you seeing there now? Like, is there any call to be made there now, or is it just more of the same?
Well, the call on Eurodollar futures is that there's some significant probability of getting down to zero interest rates, which probably means a real QE from the Fed, although the Fed by then will probably have to buy ETFs or something Japanese style, because they'll want to shock the marketplace.
You mean 0% Fed fund futures?
Yeah, the Eurodollar futures curve is inverted still pretty steeply, which suggests that there are more rate cuts coming. I know Jay Powell says, hey, it's not a series, while the Eurodollar futures market begs to differ. And there's a really good probability that the series gets it all the way down to zero again.
And that's, I'll show you a chart on that. I mean, can you guys show our Fed fund futures versus the Fed's dot plot? To guys like us, it's funny, but to most people, it's like, what the hell are you talking about? I didn't even know what the dots were until Janet dropped them in 2016. But this is, just so that everybody can see what this is. I mean, this is what I believe. I mean, I think that the Fed's only way out is to capitulate and actually help Beijing, because a weaker dollar is what the Chinese need. But people, look at this. These are the Fed's projections versus where the Fed fund futures are. Fed fund futures is the red line. I mean, we're talking about epically wrong, after being epically wrong the other way.
Right.
I mean, at this time last year, it was the opposite. I mean, not actually, maybe go back 3 months last year. But again, I digress. I mean, that to you, isn't that just a very typical picture of why you don't fight? I mean, the whole concept of fight, you should absolutely fight the Fed if that is your
You should be betting against them, especially in times like this.
100%. So it's not a fight. It's just saying I'm going to
No.
take the other side of you and make money off of you.
But if you're a central banker, you're invested in the idea that nobody should fight you because that way it's a self-fulfilling prophecy.
Yeah,
if I believe that Jay Powell knows what he's doing, then I'm going to act the way Jay Powell wants me to act.
Yeah.
That's from his perspective. That's awesome. That's the way monetary policy should work.
Yeah.
But here in the real world, it doesn't work that way.
No.
You actually have to pay attention to these kinds of things.
In this case, I believe that's why I call him PE Powell. Private equity Powell is who I think he is.
Right.
As soon as negative
stock
earnings
market signals, absolutely. The Fed is invested in stock market signals.
And private equity and non-widening of high yield credit spreads. So I'm betting that's where it is. Great updates, Jeff. Thanks for your outstanding work. I read your blog daily. You have the blog too. That's another thing. If you want to sign up for Jeff's stuff, you can find it. Obviously, I don't have the link directly. I think the team might have it. Jeff, could the SoftBank disaster be the straw that break the camel's back?
Potentially. I mean, it's impossible to predict ahead of time what is the last straw. 'Cause we're already into hey, the repo thing was a signal that we're already into a serious position. It wasn't the repo rumble itself wasn't a warning in that it was an event. It was a warning of what happens if there was an event. So we're already into a situation where we're people are thinking inside the system. People are thinking about the exits.
Yeah.
They're already thinking about how itchy is my trigger finger?
Yeah.
So what is the thing that actually makes them pull the trigger? I mean, that's impossible to predict, but I think it's important to understand that people inside the system, the very big players, are already thinking about it.
Yeah, but we live in a world where people have epic FOMO. I mean, it's just like today. You're looking at your screen today. You're like, oh my god. The futures are up again in the market. I mean, this is October 2007. Right. October of 2007, the market was on its way to making new highs, okay? And then that was it. The music just stopped early November. S&P was down 6% in November of 2007. What could possibly go wrong? I mean, people get sucked into staring at the U.S. equity futures like never before.
Well, and a lot of it, too, is that people are talking about the repo market now, but they don't really understand what's going on. And so they've assigned all of this negativity to something like trade wars. Yeah. And so on a day like today, it's, was there a tweet? Was there a tweet from the president? Was there a Chinese meeting? And so they're not really paying attention to the esoteric, boring stuff, the nuts and bolts inside of the system. They're more attuned to, I hate to say it, but what's going on. What does CNBC have plastered all over their screens? Mm-hmm. Is there something that we can say that there's a potential trade deal, even though there isn't a trade deal, even though there won't be a trade deal, but there might be a trade deal? And that's positive for stocks.
It's just macro tourism at its core.
Yeah.
Here's another good one, and maybe we'll take one or two more. If the Fed gives the banks reserves, then pays them interest on those reserves, why would the banks do anything with those reserves like provide liquidity to the market?
Well, the return that they get, the interest rate they get on those reserves is nothing.
Exactly.
They're not getting a lot on reserves. They're getting enough that the Fed is thinking that they'll hold on to reserves only as a last resort. But as we see in Europe, and Europe is probably even a better example, banks tend to hold on onto those reserves and that liquidity, even if they're getting paid negative rates. What does that say about the liquidity situation? If you're holding on to the most liquid stuff that pays you next to nothing or even penalizes you for holding it, it's a commentary about the risk-taking proclivities of the insiders of the system. Mm-hmm. So the interest on excess reserves in the U.S., banks are not supposed to be making a living at it. It's supposed to incentivize them to do something else, which they're clearly not doing. I mean, hell, when the repo rate got to 10%, 10% in repo, they were saying, no, I'd rather take IOER.
We have one of the guys on our Hedgeye sales desk used to trade repo. I mean, he traded bonds, traded repo. He came over to me that day, and he never comes over to me. He's like, doesn't talk to me.
Right.
He's just a grinder, and he came over to me, and he had his laptop, and he's just like, look at this. Look at this.
Right.
This is, I mean, it really was one of those things.
Why wasn't anybody jumping on it? I mean, you would think.
Yeah,
you're getting 210 basis points at IOER, and here's 11% in GC repo.
Yeah, somebody jumped.
Why wouldn't you do that?
Yeah, it's absolutely true.
Yeah.
It looks like we've run out of time. I'm getting the signs, as you can see here.
Uh-oh.
But The questions are great. Thank you so much for those questions, and thanks, Jeff. That was awesome, man. Like, I didn't think that talking repo and talking dollar liquidity could be so much fun, but it sounds like this is just going to be something we should just keep talking about for more than enough of a time to come.
Yeah, 2008 was not a one-off event. It was not a temporary thing that got fixed. It was a permanent inflection. And so long as we don't do anything about it, we're going to keep talking about repo and Eurodollars and all these other things until people finally wake up and say, hey, we got to do something about this before it just grinds lower and lower and lower.
Yeah, and if you want to talk, like every day, that's the whole beauty, I think, of the current communication landscape. Twitter, Jeff's out there daily. If there's something big going on, he's going to tweet about it. He's going to try to explain it. He's going to talk about it. So am I. I mean, it's not like '08 because we didn't actually have these types of resources. I mean, this is the beauty of America, and again, thank God it is in China, and they don't close out all information. But that is an important thing, and I hope you found Jeff's comments important in as much as I did, and you learned something, which is the most important part of all. So thanks for joining in. We're going to be right back with Daniel Lacalle, who's my friend over there in Spain, talking about what's going on in Europe next.